Today, let's go over a checklist of things that you should do before you start investing. Welcome back to my channel, where we talk about investing, personal finance, and dividends. Some companies pay their investors dividends, and dividends is a small percentage of the total amount of money that you invest in the company, and all you have to do is hold on to that stock. With the money that you receive from dividends, you can either cash that out or simply reinvest in the company and let compound interest do the work for you. Now let's go over the checklist of things ideally you should do before you start investing. Here are my suggestions. Now, this will work for most people, but there are unique scenarios where this is not the best approach. Let me know in the comments below and we can all learn together. Number 1, if you have any credit card debts, pay that off first, because some credit cards charge up to 20% interest fees, and you would be paying that every month. It is not worth it. After you've dealt with credit card debts, let's focus on number 2, student loan debts. If you're a recent graduate, you probably have student loan debts to pay off, unless you got entrance scholarship and kept it the entire way through university and college, like me. JK, I lost it in the first semester. I was fortunate enough that my parents were able to help me a little to pay back my student loan debt, and I eventually paid them back at 0% interest. Not everyone has that helping hand, so save what you can and repay your student loans as soon as possible without putting any financial stress on yourself. Once you're done repaying your student loans, you don't have to worry about it in the future, unless you want to go for master's or PhD. Good luck. I did 1 degree and it cost me $40,000 to get this ring. I'm good. I'm not doing anymore. After you've dealt with credit card debts and student loan debts, you should focus on any other debts or loans that you have that is more than 4% interest. Depending on what you invest in, your average return may be between 3 and 6%. Ideally, you want to pay off loans and debts that are over 4% first. For loans and debts that are under 3%, you would probably make more if you invest, because your average return on your investment is higher than the interest fees that you pay for your loans and debts. So you could pay off the interest fees from your investments and keep the extra money. This brings us to the final step, that is setting up an emergency fund. This is ideally 2 to 3 months of expenses. This fund comes into play in an event of a job loss, so you have enough time to find a new job without worrying about your monthly expenses. This fund could also help you with big emergency repairs on your house or car. Ideally, this money could be sitting in a high interest savings account or something similar to that, where A, it can grow in value. High interest savings account offer up to 2% depending on what bank you're with. And B, you can access it immediately in case of an emergency. Important point. If you for some reason take money out of your emergency fund, you should always focus on replenishing your emergency fund before you start investing, because you never know when you need the emergency fund again. Once you've taken care of all your debts and set up an emergency fund, you're ready to start investing. The important advice that I give to people is time in the market is more important than timing the market. Don't wait around for the perfect opportunity to start investing. You can set up an online brokerage account with WealthSimple or Questrade, and you could start investing as low as $1 with WealthSimple Trade. I've uploaded a WealthSimple Trade review and a walkthrough for beginners. Check that video out if you haven't already and start investing today. Once you have your investment account set up, your next question is, what stocks or ETFs do I buy? Don't worry, I'll share some of my favorite stocks and ETFs and share my opinion on them. Don't take any advice from a stranger on the internet. Yes, that includes me. Do a little bit of homework and research, and if you like the same stocks and ETFs, you can buy them as well. A key thing is consistency. Pick an amount that you're comfortable with investing every paycheck or every month and stick with it. Let's say you buy a stock and it goes down in price after you've bought. What do? Do you sell it? Do you do nothing? Or do you buy more? If you answered sell it, then that is money that you need. Do not invest any money that you need because there's a potential of loss. The drop in price means nothing. You still own the same amount of shares of that company. It only becomes a loss if you take action and sell it when it's low. If you answer do nothing, that is good. You let the market do its thing and you stay calm. That is what everyone did during the market crash. The prices dropped back in March during the market crash. All the people that stayed calm didn't lose any money because the market recovered in August. In most cases, the market will eventually recover. If you answered buy more, then you're getting more profit. Because by buying more, what you're essentially doing is lowering your average cost of one share of that company. So when it goes back up, you make more profit. My favorite strategy is to invest in well-known dividend stocks and stocks that I believe in personally that have a potential for growth and a great record of paying their shareholders dividends even through market crashes. Hold on to them forever and rake in that money. Sweet passive income for life. Dividend investing and passive income really shines with compound growth. Basically, the more money you have, the more dividends you'll receive. The more dividends you receive, the more money you have to reinvest and get even more dividends. You can buy dividend stocks, which is my favorite strategy, or you can buy growth stocks. Growth stocks usually don't pay that much dividends, but they appreciate in value over time. For example, Apple and Tesla. They have doubled and quadrupled over the past year. The reason I tend to not buy these stocks is because the amount of research that you need to put into it. Sometimes all it takes is one bad PR or one bad product release, and the prices of the stock go down crazy. No one can predict the future to that degree of certainty. If you can predict the future, message me. I have some questions for you. You can retire early if you have a comfortable amount of passive income from dividend investing. Let's say your lifestyle expenses is around $40,000 a year. That would mean you would need $1 million invested at 4% dividend yield to make that passive income and retire early. Having that financial freedom allows you to do the things that you love and spend time with family and loved ones. Make money work for you, not the other way around. So, I hear you want to start investing. Back in my day, we used to stand in line to get a piece of paper that is proof for investing in a company. Okay, boomer, that was true. But now with modern technology, you can literally do all that from your phone. You can check out WealthSimple Trade and get started with investing today. I have another video that walks you through the setup. I'll leave a referral link in the description box below. If you use that link to sign up, fund your account $100 and buy some STONKS with that, you'll get $10 and I'll get $10 as well. Let's take personal finance into our own hands and make our money work for us. If you like this video, please leave a thumbs up and subscribe to my channel for more content like this.